In September 2019, WeWork was valued at $47 billion. By October, that number had vanished. The company went from darling startup to bankruptcy in just 47 days. This isn't just a story about one company failing. It's a masterclass in how unchecked ambition and flawed fundamentals can destroy even the most well-funded business. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey. The concept seemed simple: rent large office spaces, divide them into smaller units, and lease them to freelancers and small companies. But what made WeWork different was the experience. They marketed themselves as more than just an office. They were a lifestyle brand. The appeal was undeniable. Young startups and freelancers loved the vibrancy, the networking, the sense of community. WeWork didn't just offer desks. They offered culture. They hosted events, mixers, and created a sense of belonging. For ambitious entrepreneurs, a WeWork membership felt like joining a club rather than renting office space. And venture capitalists loved the story. WeWork seemed to embody everything investors wanted: rapid growth, a charismatic founder, a scalable model, and an exciting vision. By 2014, WeWork had raised $430 million in funding. By 2017, they'd raised over $3 billion. Every round brought new investors eager to get in on the next big thing. The expansion was aggressive. WeWork wasn't interested in slow, sustainable growth. They opened new locations at a breakneck pace, often spending lavishly on renovations and amenities. They burned through cash to scale faster than any competitor could keep up. By 2019, WeWork had over 700 locations worldwide. But here's where the math started to break down. WeWork's business model was fundamentally flawed. They rented buildings on long-term leases at fixed rates, then subleased spaces at prices that often didn't cover their costs. The more they grew, the more money they lost. They were essentially paying to scale. WeWork's unit economics were terrible. A typical WeWork location took years to reach profitability, if it ever did. The company needed constant new capital just to stay alive. This wasn't a path to profitability. It was a treadmill that could only keep running as long as investors kept writing checks. Then came the IPO. In 2019, WeWork announced plans to go public. But this was a turning point. When WeWork had to file its prospectus publicly, the numbers that had seemed acceptable in private investor meetings were suddenly exposed to scrutiny, and they didn't hold up. The prospectus revealed that WeWork had lost $1.9 billion in 2018 alone. They'd only been operating for 9 years and were burning through cash at an alarming rate. Analysts began asking uncomfortable questions. How would this company ever be profitable? When would the growth actually translate to earnings? Adam Neumann's personal dealings also came under the microscope. It emerged that Neumann had been taking favorable loans from the company, building a real estate portfolio while WeWork burned investor cash. He'd also been buying up WeWork trademarks from the company at favorable prices. Conflicts of interest were everywhere. The media coverage intensified. Stories about WeWork's culture, including excessive spending on office perks and concerns about Neumann's leadership style, began circulating. The narrative shifted from revolutionary startup to house of cards. Confidence began to crumble. Within weeks, major anchor investor Softbank started having doubts. They'd previously committed to funding WeWork, but now the numbers and the public scrutiny were making them nervous. They demanded to renegotiate the deal at a lower valuation. WeWork pushed back, but the damage was done. As confidence evaporated, the consequences became immediate and severe. WeWork had to withdraw its IPO. Investors who'd poured billions into the company suddenly realized they might lose everything. The board began pressuring Neumann to step down as CEO. By September 2019, he was forced out. Neumann walked away with over $1 billion in compensation and stock sales. Meanwhile, the company he'd built was in freefall. Within weeks, WeWork announced massive layoffs. They began closing locations. The lifestyle brand was cutting corners just to survive. The company desperately needed a rescue. Softbank, having already invested so much, couldn't afford to let WeWork collapse entirely. They injected emergency capital and took control of the company. But it came with harsh realities: more layoffs, more closures, a complete restructuring. By the time the dust settled, WeWork's valuation had collapsed from $47 billion to roughly $2.6 billion, a 94% loss in just 47 days. Investors who'd believed in the vision lost almost everything. Employees who'd bought into the culture lost jobs. The company survived, but barely. What went wrong? First, the business model was flawed from the start. Losing money on every unit doesn't become profitable at scale, it just loses money faster. WeWork confused growth with progress. They prioritized expansion over sustainability. Second, the founders' conflicts of interest should have been red flags much earlier. When the person building the company is also enriching themselves through side deals, the incentives are misaligned. The board and investors should have been more skeptical sooner. Third, the venture capital industry was caught up in hype. The narrative around WeWork, disruptive, innovative, led by a visionary entrepreneur, was so compelling that investors didn't ask hard enough questions. Due diligence was superficial. Everyone assumed someone else had done the homework. Fourth, the public prospectus changed everything. As long as the numbers stayed private, the narrative could be controlled. But when forced to disclose the truth publicly, reality couldn't be denied. The same data that investors had funded suddenly looked terrifying. Finally, there's the culture problem. WeWork built a cult of personality around Newman. Employees were encouraged to follow their leader without question. When the leader's flaws were exposed, the entire belief system collapsed. Culture can amplify good decisions or terrible ones. The WeWork story teaches us critical lessons about startup evaluation. Unit economics matter more than growth narratives. A charismatic founder is not a substitute for sound business fundamentals. Conflicts of interest need scrutiny, not blind trust. And when numbers don't make sense, they probably don't. Investors who funded WeWork early made a critical error. They confused a compelling story with a solid business. They prioritized being part of something revolutionary over asking if it was actually sustainable. They followed the herd instead of thinking independently. The WeWork collapse also revealed weaknesses in venture capital due diligence. When billions are flowing and competition is fierce, the temptation to move fast and ask questions later becomes overwhelming. But rushing due diligence on a company with fundamental flaws is how disasters happen. What's remarkable is how quickly the narrative reversed. One moment, WeWork was a $47 billion beacon of innovation. The next, it was a cautionary tale taught in business schools. The fundamentals hadn't changed. They'd always been broken. What changed was people's willingness to ignore them. Today, WeWork still exists, but it's a shadow of its former ambitions. The company took a different path. Slower growth, focus on profitability, humble rebranding. It's a reminder that even the most well-funded companies can be brought down by bad fundamentals. But they can also rebuild if they're willing to face reality. The WeWork story isn't unique. It's a pattern we see again and again in tech and startup investing. Great narrative, weak fundamentals, unsustainable model, massive valuation, public scrutiny, collapse. The names change, but the pattern repeats. The question is whether investors will learn. So remember this. Great marketing and a compelling vision can hide bad math for only so long. As an investor, entrepreneur, or employee, ask the hard questions. Do the unit economics work? Is the founder putting their own interests first? Is this actually sustainable or just attractive? Because the moment someone pulls back the curtain, the story changes. The WeWork collapse was spectacular and swift, but it didn't have to be. Better due diligence, more critical thinking, and alignment of incentives could have prevented it. The lesson is clear. In investing, business, and life, fundamentals always win. Eventually, reality reasserts itself. The question is whether you'll see it coming.